mentioning to you earlier that one single hedge fund, was responsible for a third of the size of ether options on Deribit in the, last month, in trading the merge narrative. So we are seeing the space shift from very, very retail-driven to very institutional and very old-school institutional, good names being in the space. So I think the space is, at least on the trading side, becoming very prime and prep for institutional participation.
Thanks, Darius. Alex, care to comment?
Yeah, I think it's an ideal time. When you look for classical market participants, they always move into new technologies and new products in bear markets, because then you need to understand their governance. Nobody's expecting them to deliver, let's say, tremendous results in a month. In the bull market, everybody's complaining that we're not directly delivering double-digit good results. In the bear market, nobody expects that. So bear markets are fantastic. We've seen now a single institutional player dropping out because of the situation of the market. So we expect that a lot is happening in the institutional market next year, especially, as Darius said, from the classical financial world. Everybody's talking about it, and they will offer much more crypto products to retail investors too. B2B follows B2C. B2C is a little bit pulling back, but B2B will push in now in this bear market.
Yeah, I think from our standpoint, this is a good segue to Tim and Kayvon. From our standpoint, certainly, despite the sort of subsequent fallout and consolidation that we have seen, certainly in the provider space in 2022, where GS is seeing a lot more on the onboarding side, a lot more flow from people looking for traditional counterparts. So Tim, sort of curious how you see this, either now or how you sort of see this at CME and then the path forward.
Yeah, certainly. So I think when you look at the life cycle of institutional adoption of cryptocurrency, it's something that we've seen always in pretty strong fashion at CME. In the early days, we had a lot of our traditional market participants trading Bitcoin futures at CME. But I think there's two things to keep in mind. One is, what do we mean by institutional customer in the crypto space? And I think it means both traditional institutions that we're familiar with, but you also have the advent of an institutional class within crypto. So think about crypto-native hedge funds, some of the crypto-focused businesses that are out there. So you do have institutional flow, even if it doesn't necessarily meet the definition of a traditional buy-side asset manager or a traditional hedge fund. So we've seen continued participation amongst those various personas on the institutional front. Open interest is growing in our markets. Volume is growing in our markets. It's not necessarily just a US-based phenomenon. We're seeing it in all three regions, US, Europe, and APAC. But the second point is, when we look at those firms, think banks, for example, asset managers, pension plans, these are firms that have been looking at taking those steps into crypto for years. They trust the fact that CME and others are regulated institutions. We're familiar. They know what we do and how we do it. The good news is, though, is that they've been looking at it for so long that when they first were looking at Bitcoin, it was also 18, 19, 20,000. And now here we are again a few years later. So they're a little bit price agnostic, I would say, in terms of taking that final step, because they've been much more methodical, much more prudent, and they're looking to say, how do I onward provide services in cryptocurrency to my existing customer base? They're not necessarily looking to capitalize on the price movement. It's more about how I provide this service, where things like futures become a way for them to do that. So I think that's changed a little bit. It's not just a directional bet, but it's really the provision of services from the institutional community.
Thank you, Tim. Kevin, how do you see this?
Yeah, we've also at Coinbase seen institutional interest remain quite robust despite the downturn in the markets and the reduced trading volumes. I see two reasons for that. The first is what I'll call a flight to quality trend. And this was most pronounced in the wake of the UST Terra blow-up, where suddenly a lot of people woke up to the fact, sort of a rude awakening, as Darius alluded to, for the very first time, that there's really big credit risks in the world of crypto. So people started to take a really close look at the types of products they were trading, types of counterparties and platforms they were trading on, and they came to the realization that these risks were mispriced. And one of the most interesting ways to sort of visualize that flight to quality dynamic I'm mentioning, if you look at the relative market cap of Tether versus the relative market cap of USDC shortly after the blow up of UST, you see that billions of dollars very quickly flowed out of Tether. Many of those billions of dollars flowed into USDC. So you can actually see sort of this repricing of risk and the flight to quality dynamic happening in real time, sort of before your eyes, which I thought was really interesting. And what that means for Coinbase's business is that a number of customers that maybe we haven't talked to before, or maybe we talked 2 years ago and hadn't gone anywhere, were suddenly approaching us saying, hey Coinbase, we want to talk to you about custody. Maybe our existing providers in the stages, maybe we thought they were. Maybe their balance sheet isn't as strong as maybe we reckon it should be. So we started to see some new business from that perspective, which was really interesting. The other angle that I think is driving this sort of robust institutional interest, despite the down market, is the fact that the current price levels represent a really interesting entry point for those investors, and I think Tim, you alluded to this, those investors that have been looking at crypto for a really long time, the larger asset managers, the asset allocators, folks who have permanent capital at their disposal, with very long investment horizons, but who also take a really long time to due diligence, do their homework on the different platforms, and they have a very long decision-making cycle. We've seen those folks ask us to accelerate their onboarding or accelerate their conversations to activate more quickly so they can get in at what could be generational entry points into this new asset class.
Thank you, Kevin. Maybe just to talk a little bit about volatility. I think at the start of the year, volatility was a bit more suppressed on the crypto side, and really a couple of months back, really starting with the UST depegging, followed by the broader macro move, we've obviously seen this volatility pick up. Cryptocurrencies now continue to trade like risk assets. What causes that to decouple and start trading as its own uncorrelated asset class? Maybe I'll start with Darius.
Yeah, so interesting. I mean, we, at the start of the year, when implied volatility option prices started to work towards the 30-40% handle, we were worried. I think we were more scared of low volatility than high volatility. So, it's good that volatility came back, but the correlation has been very high, and reasonably so, because, I think, again, crypto is, or rather Bitcoin and Ether are trying to trade very similar to stocks, right? It becomes a risk-on, risk-off asset. The dislocations that we've been seeing, and this is where I think the interesting decouplings are, is in the balls and rates, right? So just mentioned to you earlier that last night VIX made a high of 34, while crypto balls actually get lower, right? Even the 14th October contract, which is the CPI contract, get lower as well. So you see that kind of interesting decoupling where maybe it's because there's a lot more, the crypto space is a lot more flush with USD and people are expecting prices to sideline, but you see decorrelation in terms of the balls. Credit markets are also all over the place. So I think, while we see the headline prices correlate, and I expect that to continue for a while longer, I think you see decouplings and decorrelations in other parts of the space, especially in derivatives.
Thanks, Darius. Alex, what are your thoughts here?
Yeah, I think that a lot is, just what Darius said, a lot is happening also when more, structurally more institutions players come into the market and provide a wide range. Then you will have this always in, let's say, not so frequently traded cryptos, and for the big ones you will see that this will move a little bit earlier. But for me, the really development comes with more institutional players pushing in and then offering that on a wide range, and not so much sophisticated as we have right now. And then you'll see, but in the macro environment that we have currently, with all the stuff that goes around that, I don't see it happening too fast actually. Because there's still some, exactly what's happening on the global scale. How much impact is that? There's still, especially on the retail side, there's a lot of cash is king development going on. And so there is every single, let's say, signal that I get directly triggers some reaction to that one. And so there's still, as long as we are mainly driven by, let's say, human traders, this will still be a while.
Okay. Maybe we'll jump now to the recent piece of big news, obviously the Ethereum merge. This has probably set the stage somewhat for future upgrades. Maybe we'll start with Kevin. How do you think that we're now going to see institutions continue to focus on Bitcoin and Ethereum, or is it more of a shift to other tokens or layer ones? How are you guys thinking about this at Coinbase?
Yeah, it's a good question. So at Coinbase, having been one of the earliest players to be onboarding clients into the world of crypto, institutional clients in particular, we've seen patterns emerge over the 5-6 years that we've been doing this in terms of what those institutional adoption trends look like. And the patterns look something like this, right? When you're talking about an institutional investor, and I'm not talking about a family office or prop fund, but I'm talking about a money manager who's managing external capital, is often regulated. They are extremely tuned to the reputational risk, the operational risk, credit risk, et cetera, of even touching this asset class, let alone what particular coin it may be, right? And so, typically when they make that first journey into direct crypto investing, they pick the asset which has the least hair on it, is least risky, and so that typically means something like Bitcoin and Ethereum, right? They're liquid, they have regulatory clarity, et cetera. So they'll pick Bitcoin and Ethereum as their first sort of entry point into the space, put the trade on, put it in custody, see the reporting, the operational workflow sort of work out, and they get comfortable with holding that position over time and confident that everything's working properly. But once they cross that threshold of feeling comfortable owning some crypto, it's been really interesting to observe that they quickly move up the risk curve and the complexity curve in ways that have been surprising to me, where they'll say, right, okay, I got Bitcoin and Ethereum. What about Solana? Can you give me some size in Solana? Or maybe I want to do some lending. Maybe I want to do some staking. And so we find that Bitcoin and Ethereum sort of ironically serve a little bit as a gateway drug into a pretty exciting world of crypto. And that's what we're seeing now. Post Ethereum merge, the same patterns repeating themselves.
Yeah, I personally got catapulted very quickly to NFTs starting with ETH, so I can relate to that. Tim, how do you see the future here?
Yeah, so I think one thing that was interesting about the merge is I think it also helped the market really understand how to use some of the tools out there. We had a lot of interesting conversations with the clients, particularly around options, where there's an element of uncertainty about what would happen with the price. Now, not necessarily was subscribing that the merge would be a catalytic price event for either, but there was just in the market, it was hard to ignore the fact that people disagreed on what might happen. So the fact that options give you the ability to hedge at different points on that curve, and conversely, you could use both futures and options term structure to figure out what the market was trying to tell you about price direction. So there was an educational element for the crypto community in that space of, this is probably one of the larger events, probably since we launched the future. And there's a lot of chat when we first launched about Segwit 2X and hard forks and things like that. But I think this is a really meaningful conversation and around futures and options and Ether. The second thing I think that came on point too, I think it was immensely powerful for people to understand that there are differences between the protocols, right? As simple as that sounds, but it really gave people the opportunity of what it means to go from proof of work to proof of stake, and how there are other Ethereum-like offerings out there that have other different nuanced capabilities. They scale differently, they're more transaction-friendly. So I think it was a very watershed moment in terms of people thinking about, how do I use some of this in my day-to-day? So I don't know if that necessarily gets people to go beyond Bitcoin either, but I think the conversation's changed, where we're getting much more nuanced about the differences of the various tokens and coins out there, the various technologies that are out there, and then it always circles back to, well, how do I manage the risk associated with this if I'm thinking about this from an organic and a commercial standpoint? How do I hedge some of this if I'm thinking about putting my projects or business cases onto the blockchain? So it's very interesting from that regard, and I do think in a few years' time we'll see more and more beyond Bitcoin and Ether, and I think we'll look back to the road and say that's when people really started to understand some of the fundamental differences.
Thank you, Tim. I guess during this period of volatility, curious to know how it's impacted volumes on exchanges, and then I guess to go further, what do you think the next catalyst is for more participation? So maybe Alex?
Yeah, I mean, we've seen that the market cap for certain currencies is going down and the price is going down. But when you look at volatility, we had some, let's say, sideways movements starting this year, then it picked up a bit, and now we are up and down, up and down. But let's say trading volumes overall are not slowing down that much. It now really depends on whether we see a longer, instilled by maybe macro environment, a longer sideways development that will be negative for the exchange naturally. But otherwise, the volumes are still very good. And for me, coming back again to that one, B2B follows B2C. We have seen over the last couple of years a tremendous push of retail customers into the crypto space. That made the classical financial institutions greedy to get hold of these new clients. So they move into that space. They use the bear market and then open up a totally new product universe of a standardized, for customer standardized way to address into new markets and to say, or existing classical financial markets. And that's then for me the next step, where already a lot of, let's say, regions are suggesting 1 to 2% cryptocurrency in their portfolio. This will increase even more over time. And with adding, let's say, licensed derivatives, which I see as a big thing for next year, this will open up a totally new universe when you look at the volumes of classical derivatives to classical spot, and you compare that to the crypto world, you see we're just at the beginning of the volumes that we'll see. And next year is a big year for that one. So that's for me the driver.
Thank you, Alex. Caleb?
Yeah, so Coinbase has the largest pool of regulated spot liquidity in the world of crypto. So we've also observed a dramatic decrease in volumes over the preceding 9 months. And what's been interesting is that within that drop-off in volumes, we've seen that retail volumes have dropped off disproportionately compared to institutional volumes. One of the reasons for that is the fact that, if you look at these institutional adoption trends, you had way back in the day, you had family offices, prop firms, market makers, and then starting in 2020, 2021, we finally started to penetrate the hedge fund segment, particularly the macro hedge funds. They came in, built some large positions. Then late last year, earlier this year, as the global macro picture started to turn, those hedge funds got out there pretty quickly. So those hedge fund flows are pro-cyclical in the same way that retail flows tend to be pro-cyclical. They funnel in, they funnel out, right? And so that was sort of the story of institutional adoption of crypto up until earlier this year. One of the cool things we're seeing in this down market, as I alluded to earlier, is larger buy and hold type institutions with much longer time horizons like asset managers, asset allocators, et cetera, coming into the space, making that first wave of initial allocations into this new asset class. And that has driven institutional volumes higher than they might otherwise be. So that's the point about volumes. In terms of what could drive renewed participation amongst retail or institutional, who really does? Obviously the global macro picture needs to turn around. I think increased regulatory clarity in key markets like the US would really remove a lot of sort of overhang and uncertainty from this space. But actually the more interesting thing, and the thing that I love so much about crypto is we don't really know what's going to drive that next wave of adoption or enthusiasm, but it's going to be something, some piece of innovation that comes out of nowhere. It's going to surprise us the way that DeFi did a few years ago, the way that NFTs did. This morning Coinbase released a blog talking about decentralized identity and the way that could potentially pull thousands or millions of new users into crypto for use cases that are totally unrelated to speculation and trading, right? Or maybe something else, I don't know, but that's the great thing about being in this space is you have open, permissionless innovation, and something is going to come to the fore.
Thank you, Caleb. Maybe we'll jump now to the corporates. Obviously, we've seen a number of large corporates buying crypto, holding on their balance sheet, or supporting crypto in some way, shape, or form. Most of the headline names, anyway, have been out of the US. Sort of curious to think here, where does Asia sit versus this? So what are some of the biggest differences in the local markets, and is Asia corporate market getting involved here? Darius?
I think on the trading side, even not much corporates, but family offices, funds, I think they're less buy and hold types and more trading types, right? So they tend to participate on a very narrative-driven basis. So I think this year, when with the ETH merge, we saw a lot of interest in ETH derivatives. We saw ETH open interest for the first time, BTC open interest. So it's very narrative-driven, right? So the next big narrative in line is probably the Bitcoin halving in 2024. So the question that we all have is, what's the next narrative in between from now to 2024? So I think that's something that we should all look for and look forward to. So to answer your question, I think the Hong Kong, Singapore, the Asia space tends to be a lot less buy and hold directional and a lot more volatility driven.
Thanks, Darius. Alex?
I fully agree. When you move around, it's really the US is for them also an asset to store, to hold, to all of them say. Europe is a bit in between, and the companies are not talking about the holdings that they have, and Asia is all about trading. All the discussions you have is all about trading. All the family offices, whether it's arts, whether it's anything, it's all about trading. Hey, can we tokenize it? Can we trade it? Off, can we trade it? And that's all the story. Maybe it's a mentality thing, but you can really see it. It's shifting when you travel around. It's shifting by this, and for me, it's just about trading. That's it.
Excellent. Kevin, maybe on that?
Yeah, I'll echo a lot of what's already been said, and I just want to maybe preface what I say in terms of, corporates I see differently than institutions. Institutions, asset managers, hedge funds, et cetera, are really, for me, the ultimate prize